Hello, welcome back, guys. I hope you had an awesome weekend. And let me thank you for the amazing viewership that my latest video on PayPal has received, a company that I bought a few days ago, and it looks like a lot of people were interested in, for a good reason, of course. And in this video, we're going to be talking about 3M. Now, if you haven't watched the PayPal video, I'm going to be linking to it at the end of this one. But in this particular video, we're talking about 3M, and it is a company that quite a few people have been asking me about, and it makes a ton of sense because it is a dividend-paying company that is paying quite some, and it's actually a dividend aristocrat as well. And so, generally speaking, this is considered a very safe company in regards to the dividends, and they have been raising their dividends for a consecutive 25 years at least since they are an aristocrat. Now, we're going to be taking a closer look at the financials, of course, as we always do. Before we do that, I kind of wanted to take a little bit of a look at what has been going on with the price, and you will see that the company is on a massive decline in terms of its stock price. Doesn't mean that the company's financials are in a decline, of course, but we're sitting pretty much at the lowest the company has been for the past 5 years. And if you take a look at the max chart of the company, basically what they have been doing through the years, overall they have been doing tremendously well, but lately they have been stalling, and for a few years now, which could prepare us for a potential, uprise eventually, who knows. So it could potentially be an interesting entry point as it's going down, of course. I wouldn't want to be buying here, for instance, or maybe even here. It would be also like all-time highs, especially for a company of this sort. It would probably be expensive. But right now, it may actually be too cheap to avoid. Now, let's take a little bit of a closer look at the financials, and it's worthwhile noticing that the company had the issues with litigations and some lawsuits pretty much, and you will see that this article, for instance, is talking about it, and the cost of all these litigations has been quite some for the company. Like they spent about $1 billion in 2021, as you will see. 3M used up over $1 billion in cash in 2021 and 2022. But it does appear like there's going to be some sort of a settlement here. That's what I have been reading, and that's what I would expect from the company. Companies get sued all the time for all sorts of reasons. It happens way too often, and I don't anticipate that 3M is going to go down because of this issue with the veterans, pretty much, and the ER protection thing. Definitely they will lose some money, but for new investors it could actually provide an interesting opportunity. But that's a risk to bear in mind if you are looking to enter. Now, the PE ratio is sitting at 10 and the price to free cash flow at 14. It's a little bit higher, but this has to do with the costs that the company had that I talked to you about. And this would probably be even lower, maybe even significantly lower if it wasn't for that. And I'm going to explain a little bit later in the video. Now, the outstanding shares have been going down. The company has been buying stock, so this is obviously an awesome sign. And the company has some liabilities compared to the free cash flow that they made last year. But again, the free cash flow has been suppressed, so they don't really have too many liabilities compared to the free cash flow, as you will see again a little bit later in the video when we dig deeper into the free cash flow that the company has been generating. Now, the biggest trouble with these kinds of companies, and 3M is one such company, is that they are not really growing. You will see that they are stalling. In the past 5 years, they are basically where they were. Like 5 years ago, like a 5% growth is basically no growth. And the net income is the same story, and it's only the free cash flow that has been going down because of last year, pretty much because of the issues that I mentioned. So basically, again, this would be flat if it wasn't for the litigations and all that. Now, the total equity of the company has been going up overall, which is a nice thing to see. And their net income margin is sitting at about 16% pretty much every year, frankly, which is nice because you know what to anticipate. And the debt to equity is a little bit higher than would like it to be, but it is a company that should be able to service it quite easily, frankly. Now, the dividend is very, very important, and the payout ratio, you will see in regards to the free cash flow, is 90% almost, 86%. But again, this has to do with the fact that the company made less free cash flow. The payout ratio, which is in relation to the net income, is about 60%, 61%, which is, while it is a little bit, a little bit much, it's not, it's not a ratio that should forbid you from potentially enter the company. Would like it to be near the 50s, but 60 is doable, definitely. And the free cash flow payout ratio will probably be around the 60s next year, especially if the company makes its normal free cash flow pretty much. Now, the thing that I want to take a look at is obviously the statements. They will tell us a little bit of a story. And it's always worthwhile to take a look at the 10-year period, and it's something that we have added to the tool. And you will see, it will actually show you that the company basically is not really growing. In the past 10 years, they are where they were, pretty much almost. Like 4 billion extra is almost nothing compared to other companies that can give you growth, much more growth. But there's a lot to be said about the stability. And again, you are buying this company for the dividend, and a 6% dividend is nothing to sneeze at. It's not bad at all. And the net income of the company, kind of the same story, a little bit of growth, but again, kind of the same story, sitting at similar levels. The balance sheet of the company is getting a little bit better, as they are accumulating some some income through the years. They start filling their coffers, and they make some some nice retained earnings here, and eventually the total equity keeps growing at a nice pace. Not at a tremendous pace, but at a nice pace. And the cash flow statement, as you'll see here, is what I talked to you about. The operating cash flow has been a little bit less compared to the previous years, but I do expect, fully anticipate to go back to where it was. You will see that the net income hasn't really been affected, and it's basically the cash flow that has been extracted from the company pretty much, and caused the issues here for the free cash flow. And again, this probably is going to be temporary. Is the nice thing about it, is what I like to see. And this actually definitely affected the free cash flow, and this is why you were looking at a higher free cash flow payout ratio. This is the reason, the fact that they made less. If they made what they made 2 years ago, then we were sitting at about 60%, if not less, frankly, which is nice. Now, what I want to obviously take a look at is our dividend discount model here. This is very useful in this case, because if you take a look first, let's take a first pass at the dividends tab here with our tool. And remember, all of our patrons have access to this tool, and you can take a look at it with any stock that you like, of course. And you can find a link in the description box below this video if you're interested, of course, in getting access to it. And the dividend yield right now is 6% pretty much. And you will see that the company has been increasing and increasing and increasing their dividends through the years, which is amazing. And right now they're paying 1.5 dividends a share, $1.5 a share. Now, we will take a look at our dividend discount Gordon model pretty much, just to see what we should anticipate in regards to the dividends. Like, is the company worthwhile buying in regards to what they are paying in dividends? You will see that the dividend growth rate has been stalling. They keep increasing it because they have to in order to to maintain the aristocrat thing, but they have been increasing at a slower pace. So for this reason, the dividend growth that I'm going to be using is what they have been having in the past couple of years or so, around that. And you will see that the tool actually tells you that the average dividend growth rate in the past 5 years has been, the past 4 years pretty much, has been 1.6%. I will go lower. I will go 0.5, then 0.7 here, and let's just go 1%. That's like almost like our best case scenario. And it could be higher, don't get me wrong, but I just want to be safe, especially since the company has been having these troubles lately. Now, the annual return that I'm going to be asking it for, typically I ask something for like 7 to 8% for the dividends, because you get the extra growth from the company stock price as well, and especially when you buy it low. So 7 to 8%, it makes a ton of sense. So let's ask for 7, 8, and maybe even 9. Let's just stretch it a little bit. Now, you could also try using the same annual return, because obviously this will affect the results. And when I hit calculate, you will see that for this kind of growth and this kind of annual return that we are asking for, we're getting a 92, an 82, and a 75 here. And obviously we're asking for higher returns here, so this is why we're getting lower values. Now, what would potentially make sense as well is to ask for a 7%. 7% every year with this kind of dividend growth. And we hit calculate, and then we're getting to where we are right now, about $100. When the dividend growth is higher, when it's sitting at about 1%. And when it's lower, then it's a little bit lower in regards to the price that we should be paying today. But we're almost there if we're looking at this kind of projection here. It looks like it's sort of like fairly valued actually in regards to the dividend. But we also need to be taking a look at our discounted cash flow model. So what is going on with the cash flow? We do know that the cash flow last year wasn't impressive, but we do know that it's probably temporary. The revenue growth that the company has been achieving has been hit in the past year, pretty much the past year. And overall, we're sitting at about 1.6% for the revenue growth in the average. As you saw, this is about what the company has been doing for the past 5 years. I'm going to go a little bit in between. So 1%, 1.3% and 1.5% is what I'm going to go for. And the net income margin that I'm going to be using is going to be basically near 16%, because that's what the company is doing pretty much every year. And I'm going to go 15, and then let's go 16 and 16.4, let's just say. The free cash flow margin, about 100% is what the company typically does, and a little bit more potentially in some situations. 90, 100, and 110 is what I'm going to use. And the annual return that I typically use, about 13%. I hit calculate on this one, and you will see that we are well within where we would like it to be. So based on the discounted cash flow that the company will be generating in the next few years, we're already there. This is already a relatively cheap company. So I do like what I'm seeing here in regards to the cash flow, and I do like what I'm seeing in regards to the dividend. And remember again, the dividend is sitting at 6%, and this is a nice thing about buying these kinds of companies when they are getting lower and lower, because you are getting a lower effective pretty much dividend yield. Remember, as dividend paying companies go down for various reasons, while they keep paying the dividend that they were paying, because this is also a dividend aristocrat and they keep increasing their dividends, remember they are paying, again, the little tab that we have here with our tool can tell you the story. They are paying 1.5%, $1.5 as a dividend per share. And remember, the dividends are paid per share. They are not paid, in regards to the stock price. They are paid per share. So if you own more shares, you get more dividends, which means that if the stock price goes down, you can buy more shares. And this is why your effective yield, that's the dividend yield that you are getting, is at 6%. Now, if the company's stock price goes at $200, then this dividend yield would be 3%. So it will go down significantly, as you can understand. And this is why it may make a ton of sense to be buying this company right now, as it is paying a 6% dividend. And of course, if it keeps going down, it will give even better yields. But I do like what I'm seeing right now, and it is a company that I would seriously consider adding to a portfolio, especially a long-term sort of like passive income portfolio, out of which I want to be getting solid dividends. It is a company that I would definitely look to potentially add, and I do think that even right now, sitting at $100, it's a pretty solid deal, frankly. Obviously, if it goes even lower, it's going to be even better. You're going to get better yields, basically in relation to how much it goes down. But at $100, this looks like a solid opportunity, and it's definitely a company that I would add to a portfolio. Again, remember, this is not a growth company. It's not a company that I would expect it to fly. Although it could fly, because it has been going down a lot, and at some point, it could start going up again. Maybe reach $200, very likely, eventually, maybe a few years down the road. But what I would definitely buy it for, and this would be the star, is definitely the dividend. 6%. Out of 3M, out of a company of this sort, is fantastic. So yeah, it is a company that I would consider buying even right now at $100. Thanks for watching. I hope you enjoyed. Remember to leave a like and subscribe. A like really helps a ton, and a subscribe even more. So thanks for watching, and I'll see you soon. Bye bye.